guys, it's Vivian, your hot stock girl. Today I'm going to do something a little different. I want to give you an idea about how I find small cap stocks that are worth investing in. The whole idea is to make money. The way to make money in the market is to invest in companies that have made changes that can grow the company's profits. Finding these types of companies isn't easy, so it doesn't hurt to see what some professional investors are doing. One thing that can shake up a company is when an activist investor starts buying shares of a small company's stock. You can find this information by looking for 13D and 13G filings on sec.gov. I'm going to discuss 3 small cap stocks that were being accumulated in 2018 by a very successful activist investor. An activist investor is a shareholder that buys enough shares in a stock to put pressure on its management. Quite often, the activist investor finds undervalued small cap stocks and forces management to make significant changes or to find a buyer to acquire the whole company. The activist investor I'm going to discuss today is David Kanen. He runs an investment firm called Kanan Management, based in Coral Springs, Florida. I found Mr. Kanen when I saw that he was accumulating shares of a company called Bravo Brio Restaurant Group. Whenever an investor acquires more than 5% of the shares of a company, he must file a 13G or 13D filing with the SEC. To make a long story short, David Kanen started buying Bravo Brio shares between $2 and $3 per share in late 2017. And by March of 2018, Bravo Brio was bought out for $4.05 per share. So today I'm going to share with you 3 small cap stocks that David Kanen was buying in 2018. Hopefully we can make some money with David Kanen's stock purchases in 2019. The first stock that activist investor David Kanen was buying in 2018 is Famous Dave's of America, Incorporated. The ticker symbol is DAVE. The first Famous Dave's barbecue restaurant was opened by David Anderson in Wisconsin in 1994. The company grew its restaurant base for years, and the stock price peaked above $32 per share back in 2014. Recently, there have been store closures, declining margins, and earnings losses. These events has caused the stock price to plummet to where it's trading under $5 a share today. So why am I bringing Famous Dave's to your attention now? There is more to Famous Dave's than just an activist investor getting involved. There have been a big shift in Famous Dave's business model that could position the company for better days in the future. Famous Dave's used to own all of their business locations before they started franchising some restaurants. New management took over in 2017, and Jeffrey Crivello has become the CEO. Famous Dave's has closed several unprofitable locations and has sold other stores to its franchisees. Dave's now owns only 16 locations and has 131 restaurants owned by its franchisees. This shift in the business model has allowed the company to dramatically lower its expenses. Famous Dave's will now derive the majority of its profits from royalties that the franchisees have to pay them. You may or may not know this, but McDonald's doesn't own most of its McDonald's restaurants. McDonald's business model is set up just like Dave's, with their franchisees owning most of their stores, allowing the company to collect royalties. The biggest difference is barbecue meat is not fast food. It takes hours to cook good barbecue. In spite of this, Famous Dave's has plans to expand its Clark Crew barbecue concept and offer drive-thru service and home delivery to its customers. Getting barbecue ribs delivered to your home would be a nice alternative to the usual pizza delivery, but I'm not sure it's really practical. Eating cold ribs sounds pretty gross. I do think their drive-thru service could become very popular. Famous Dave's is also trying to improve their customer retention. In October 2018, Famous Dave's signed an agreement with a company called Mobivity. Mobivity has a system that they call a recurrency platform. According to their website, Mobivity's recurrency platform is designed to help business owners increase customer frequency, spending, and loyalty through the use of the data-driven insights. Mobivity starts by leveraging purchase data to understand, predict, and influence how your customers make their buying decisions, and to create personalized marketing initiatives that drive sales and frequency. Mobivity's platform reminds me of the player tracking cards that the casinos used to get you to come back to the casino. It certainly makes sense to know your customers if you wanted to come back to your restaurant. Now, there are many reasons why you might want to do more research on Famous Dave's and possibly add the stock to your high-risk portfolio. Not only is Famous Dave's trading at a very low valuation at around 4 times EBITDA, but its chairman has incredible experience with franchising restaurants. Charles W. Moody was added to the board of directors of Famous Dave's in late 2016 and is now the chairman of the board. Mr. Moody was a high-level executive and board member at International Dairy Queen. Dairy Queen, which is owned by Warren Buffett's Berkshire Hathaway, is one of the most successful fast food franchisors in history. With Mr. Moody's experience, Famous Dave's has a really good shot at being a very successful franchisor, and this undervalued stock could be a huge winner from here. The next stock activist investor David Kanen was acquiring in 2018 is the One Group Hospitality. The ticker symbol is STKS. The One Group is a hospitality company that develops, owns, and licenses restaurants and lounges throughout the world. The company operates restaurants primarily under the STK brand. As of December 31st, 2017, there were 31 locations in the United States, Europe, and the Middle East. The company was founded in 2004 and is headquartered in New York City. David Kanen bought stock as low as $2.20 per share and as high as $2.95 per share. He now owns over 3.2 million shares of the company. While Famous Dave's is showing modest same-store sales growth and trading at a low valuation, the One Group is showing tremendous same-store sales growth. Their SDK restaurants are like a steakhouse with a modern lounge-type vibe going on. I had a chance to try out the SDK restaurant in Los Angeles, and it was really good. The company also made a recent change in management when it named Manny Hilario as a president and CEO in late 2017. Manny Hilario is focusing on opening their STK steakhouses in upscale hotels across the country. When they reported third quarter earnings in November, their same-store sales were up a strong 6.9%. This led to a 41% increase in adjusted EBITDA. Then on January 10th, the company issued preliminary fourth quarter results. The company said that total revenues are expected to be approximately $25 million, which is a 60% increase from $21.5 million for the same quarter last year. The company also said domestic comparable sales at owned and managed SDK restaurants rose 15% from the prior year period. This is amazing growth. Last month, the analysts at Piper Jaffray initiated coverage on the One Group Hospitality with a buying rating and price target of $4. The third and final company that activist investor David Kanen was buying in 2018 is US Autoparts Network. The ticker symbol is PRTS. David Kanen has taken a serious interest in this company, having purchased around 4.5 million shares of US Autoparts stock. US Autoparts is one of the largest online providers of aftermarket auto parts and accessories in the United States. US Autoparts operates through its network of e-commerce websites and online marketplaces, including J.C. Whitney, which has been in business for over 100 years. The stock is currently trading right around $1 per share due to year-end tax loss selling. Now, I normally wouldn't bring you a stock trading in the penny stock range, but US Autoparts is a solid company with no long-term debt and around $300 million a year in sales. With the stock trading at just 3 times trailing 12-month EBITDA, it is surely trading as a value stock. So, how did US Autoparts drop so low, and is it a value stock or a value trap? US Autoparts went public back in 2007 at $10 per share. The two co-founders, Mehran Nia and Sokasani, and their families still own about 29% of the shares outstanding. Back in May 2015, Mehran Nia sent a letter to the board of directors saying that he recommends the board of US Autoparts explore a sale to maximize shareholder value. At that time, he estimated that the private market value of the company was $4 to $6 per share. From 2015 to 2018, the company performed very well. They consistently grew sales, which allowed them to pay off all of their long-term debt. The company was producing strong growth and solid EBITDA gains through the beginning of 2018. Then in March 2018, the United States Department of Homeland Security seized 200 containers in the port of Newark, Virginia that belonged to the company. The issue was some automotive grills that may have infringed on the logos of some of the automakers. It took several months before a judge ruled in U.S. Autoparts' favor and the containers were released. Unfortunately, U.S. Autoparts had to pay legal fees and storage fees for the containers while they were in the port. Then they had to deal with issues where they ran out of the stock on items that were stuck in the containers. Fortunately, these problems are over with, but 2018 results suffered significantly for the company. However, these problems may have created an extraordinary buying opportunity. At least David Kanen seems to think so, seeing that he now owns close to 15% of the company. The company also announced that they are bringing in a new CEO to manage the company in 2019. The new CEO, Lev Peker, previously worked at U.S. Autoparts from 2008-2014. He left to run his own company and is now back to running U.S. Autoparts. Also in 2018, U.S. Autoparts signed deals with Amazon and Walmart to sell their CoolView brand mirrors and other auto body parts. Though profit margins will be slightly lowered on these sales because Amazon and Walmart get a cut, U.S. Autoparts will save a lot of money on shipping and returns. On January 23, 2019, U.S. Autoparts Network appointed David Kanen to its board of directors. It is rare that an activist investor is put on the board of directors of the company. Most companies resist the overtures of an activist because most activists want to force companies to get bought out. It certainly would be great for U.S. Autoparts investors if David Kanen helps the company get acquired. So there you have it. My thoughts on 3 small cap companies that activist investor David Kanen was buying in 2018. These stocks are all small caps in a turnaround phase, so they are high risk, but the reward may be worth it. At least one activist investor seems to think so, so do your due diligence. I'm Vivian, your hot stock girl, and please be sure to subscribe below and check out my other videos for great investment ideas.